Hey everyone, in this video I'm going to bring you what I believe is a significantly undervalued growth stock that's down almost 94% off its high. I'm going to discuss why I like this growth stock so much, why it's down so much, the risks, and the reasons why I'm recommending this stock as a buy at these valuations. So let's jump right into it. Let's see what this company is.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the growth stock I'm recommending in this video that's down nearly 94% off its high is Fiverr International, the gig economy platform company that's Israeli based. So the war in that region is really hurting its valuation on top of the already diminished valuation it experienced due to its decelerating revenue growth. But that lower revenue growth is coming with more profits, more cash flow, and a better business overall, even if it's growing more slowly. I tend to like companies that focus on profitable growth rather than just try and grow as quickly as they can grow without regard to the costs and losses on the bottom line. So let's take a closer look. So I mentioned one of the reasons why Fiverr International stock price is down so much is because of the decelerating growth rate. You could see here in 2021, its revenue growth approached 100% for a quarter or two here, 90%, and since then it's been decreasing. Right, that revenue growth rate has been decelerating, but it bottomed out in mid 2023 and it increased again, it accelerated. So revenue growth of 10.07% is solid. It's not growing at the rates it was growing in 2020 and 2021, but very few companies are growing at the rates they grew in 2020 and 2021. The economy overheated during that time, especially companies that benefited from the stay-at-home trend, as governments worldwide injected trillions of dollars of stimulus into the economy. Interest rates were lowered to zero, and people were spending more time at home, spending more money on digital things and less money away from home. So all of that led to booming growth for several companies, and Fiverr was one of them, and you should expect a slowdown as a result. Now, longer term, I think Fiverr International will continue growing the business. I think hiring individuals through gig economy platforms like Fiverr and Upwork are really, really attractive, considering the alternative, hiring employees full-time, going through the whole human resources process. That can be a bit of a difficulty, a bit of a challenge, especially for smaller businesses that are not yet sure they want to bring somebody on board full time. The gig economy offers a nice flexible option, and that's better than the former flexible option companies had. Remember temporary agencies? They used to be more apparent in the economy. Now these gig economy platforms are making it more easy for companies to hire this kind of temporary labor, you can call it. And if that proves to be effective, those workers can be brought on board full time, or they can continue in this format. It offers a win-win situation for both the company and the workers. It offers the workers the flexibility, and it offers the company the flexibility to work from home and not be committed to just one company, to one provider, and they can look around and have multiple offers from multiple individuals. And so I think this trend will continue longer term, and that tailwind will lift all companies in this category, Fiverr International included. I mentioned that the slower growth is coming at more profitable growth, more profitable levels. You can see its cash flow from operations. It was negative 60% to start 2019, and that's jumped all the way up to 23.02%, moving in the right direction, becoming ever more profitable in terms of this metric, ever more positive, I should say, in this metric in cash flow from operations. The company is now fully self-sustainable, doesn't need to reach out to investors for capital. In fact, Fiverr International is using its cash flow from operations to buy back its shares, in an indication that management also, like myself, believes that its stock is undervalued. I agree with management. I think its stock is undervalued as well. And when you've got a self-funding, self-sustaining business that's generating strong cash flow from operations, you can use your cash flow and buy back your shares. That reduces the number of shares outstanding, and it increases the earnings per share. It can be a good use of capital when you feel that your shares are undervalued and your growth rate, and you don't find other growth opportunities for that capital. So this is what's happening with Fiverr International. And longer term, the analysts on Wall Street that are following Fiverr International, they think it's going to deliver $2.09 in earnings per share in 2024, and they think that's going to grow to $2.32 in 2025. So roughly 10% earnings per share growth, a little more than 10% earnings per share growth expected for Fiverr International. Now, if you look at the trend over the last 90 days, you can understand why the stock price has been under pressure. 90 days ago, analysts on Wall Street were expecting $2.84 in earnings per share for 2025. That's been lowered to $2.32. And for 2024, they were expecting $2.23, and that's been lowered to $2.09. So the earnings per share expectations have been decreased in the last 90 days for Fiverr International. That's partly explaining why the stock price is down so much off its high, although that's more of a near-term thing. Longer term, the bigger reason the stock price is down is because of the significantly decelerating growth rate and the impacts of the war in Israel and how that affects Fiverr International, which is an Israeli-based company. So I mentioned all of these factors and characteristics of the business, but the most apparent is its undervalued valuation. Its undervalued stock price. It's currently trading at a forward price to earnings of 8.609, the cheapest that this stock has been in the last couple of years. And I highlighted some of the risks apparent in the company, why this stock is trading at that valuation, but I think it's more than accounted for here. And if you're a longer term investor willing to look past the near term headwinds and look at the company's fundamentals, its solid growth, it's still expanding, the secular tailwind pushing it industry growth higher, the cash flow from operations increasing, and the expected increases in earnings per share over the next couple of years. It makes for an attractive stock, albeit with elevated risks. To be sure, it's a higher than average risk stock, but you're getting it at a way lower than average valuation. The average valuation in the S&P 500, the forward price to earnings, is somewhere between 17 and 19, 17 and 20. You're getting Fiverr International at less than half that price. You're getting it at a forward PE of 8.6. So those risks are accounted for in its valuation. Otherwise, you wouldn't be able to buy Fiverr at this valuation. You would have had to pay a higher forward price to earnings ratio without those risks. So you're getting a company with higher risks, but you're getting it at a lower price to compensate you for the elevated risk that you're taking. And in my opinion, the risk versus reward is worthwhile for Fiverr International stock. In fact, I have Fiverr International stock rated as one of my top 25 stocks to buy in 2024 and one of my top 10 growth stocks to buy in 2024. And I'm updating this recommendation today, April 12th, reiterating that I still believe it's a top 10 growth stock and a top 25 overall stock to buy right now. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.